The markets are restless again, but this time, it isn't interest rates or debt ceilings shaking the ground. Something deeper is stirring in Washington. A quiet panic spreading before a single decision has even been made. Inside the Treasury, Scott Bessent, the new face of American finance, is walking back the own threat that shook the world. Trump's call for 100% tariffs on China. Behind closed doors, everyone knows why. The United States no longer holds the upper hand. For decades, it ruled the flow of global capital. Now, China rules the flow of the materials that make the modern world possible. The metals that power electric cars, smartphones, satellites, and weapons. They're Earth's, invisible to the eye but essential to everything. And even though Beijing hasn't tightened the tap, Washington already feels the squeeze. Markets are moving on whispers of peace, and investors are asking the question no one in power wants to answer. Who's really in control now? When Trump made his threat, the world prepared for a storm. But instead of confrontation, Bessent launched a charm campaign. Cameras followed him across continents. London, Seoul, Tokyo, repeating one message again and again, that China had turned supply chains into a weapon, and that the world must resist. It was a speech that sounded familiar, almost an echo of Janet Yellen's warnings from years before, when the US accused Beijing of flooding the world with cheap cars and steel. Only this time it wasn't about overproduction. It was about dominance. Control of the materials that power every chip, every missile, every motor. Before Bessent's tour began, Washington had already raised tariffs on Chinese imports, some up to 145%. The response from Beijing was swift. Within weeks, China's exports of rare earth elements to the US plunged by more than 60%. Tech companies panicked. Defense contractors scrambled. But even then, China never shut down the supply entirely. It simply redirected it toward India, Vietnam, Thailand, and Germany. In a matter of weeks, global trade had stabilized again. Beijing had made its point, and panic ripples through. It wasn't trying to collapse the world economy, only to show Washington how easily it could. As American buyers searched desperately for alternatives, China's state firms quietly redrew the map of supply routes. New contracts were signed across Asia. Every shipment that bypassed the US was a reminder of who held the leverage. In the corporate towers of Tokyo and Berlin, the message couldn't have been clearer. If China can reroute the world's most critical materials overnight, the balance of power has already shifted. And while Bessent promised stability and new alliances, Beijing didn't need promises. It had proof. China's power in this standoff doesn't come from speeches. It comes from control, built over years of planning. Today, around 70% of rare earth mining and nearly 90% of refining happens inside China. These minerals are the foundation of everything that defines modern civilization. Smartphones, jet engines, wind turbines, electric vehicles. With that kind of control, Beijing has two levers it can pull anytime it wants. The first, restriction. A slowdown in exports instantly raises costs for Western manufacturers. Every battery, every sensor, every motor becomes more expensive. Factories hesitate. Investors retreat. Fear spreads faster than any tariff ever could. The second lever works in reverse, oversupply. By flooding the market with cheap materials, Beijing can destroy foreign mining ventures before they even start producing. American firms like MP Materials already depend on heavy subsidies. A wave of low-priced Chinese exports could erase them from the map in months. It's not theory. China's done it before. In 2015, it briefly restricted shipments, then unleashed a surge of exports that sent global prices crashing by 60%. Competitors vanished overnight. And today, it doesn't even need to act. Just one statement from Beijing can move markets. If the United States continues on its wrong path, the Commerce Ministry warned, China will take the necessary steps to defend its interests. One sentence. Wall Street. That's how fragile America's position has become. Back home, facing outrage from investors and chaos in the markets, Bessent tried a new approach. Instead of more tariffs, he called for unity, a coalition of democracies to push back against China's dominance in critical minerals. It was an old idea dressed in modern language, Fortress America reborn as the global alliance. He spoke of gathering the G7, India, Japan and Europe to stand together. We won't allow these restrictions to continue, he declared. But beyond the speeches, the cracks were already showing. Europe, sliding toward recession, can't afford another economic shock. Its green tech and auto industries rely almost entirely on Chinese materials. Germany's EV sector alone depends on China for over 80% of its rare earth components. Japan and South Korea, still recovering from earlier US tariff waves, want calm, not conflict. Even India, supposedly the counterweight to Beijing, remains deeply tied to Chinese supply chains. In 2024, trade between the two nations reached $136 billion, much of it driven by Chinese solar and electronics parts. So while Washington talks of alliances, the world quietly moves in another direction. America's campaign to corner China instead reveals its own isolation. On paper, the allies nod along, but in reality, none are willing to sacrifice their industries for someone else's strategy. And in that silence, a truth becomes clear. Power doesn't belong to the loudest voice anymore. It belongs to the nation that controls what the modern world cannot live without. While Bent struggled to rally support from foreign allies, Beijing was quietly setting the stage for a move that would strike straight at the core of America's financial strength. As Washington tried to mend its diplomatic ties, China opened a far more subtle front, one that wouldn't require armies or speeches, but money. What once seemed like a quiet adjustment in Chinese investments has now evolved into a full-scale withdrawal from U.S. assets. Back in 2016, Chinese firms poured more than $57 billion into American companies and real estate. Today, that figure barely scrapes past $2 billion, the weakest level in over 10 years. At the same time, Beijing has been steadily offloading U.S. treasuries, choosing to either sell them outright or simply let them mature without reinvesting. Just in recent months, over $25 billion worth of U.S. bonds have quietly disappeared from China's balance sheet. Each time Beijing steps back, U.S. yields inch higher, tightening America's own financial noose. As the Federal Reserve tries to relax policy, rising borrowing costs make the effort self-defeating. And with national debt already past $37 trillion, losing a major foreign lender only makes things worse. Economists say that for every $100 billion decline in foreign demand, long-term yields jump by roughly 10 to 15 basis points. It's not panic, it's precision. China isn't fleeing the dollar, it's untangling itself from it, turning toward gold, natural resources, and regional ventures stretching from Asia to Africa. While Washington argues over tariffs, Beijing is rearranging the pillars of global finance. The outcome is slow, steady, and devastatingly effective. A gradual weakening of America's economic grip. As the bond market wobbles under this pressure, new trade data from China paints an even more revealing picture. In September 2025, Chinese exports surged 8.3%. Reaching nearly $30 billion, the fastest pace in half a year. While sales to the U.S. fell by 27%, booming trade with Southeast Asia, the Middle East, and Africa easily made up the gap. Those regions saw growth of 15 to 18%, fueled by the vast Belt and Road network Beijing has spent years constructing. Even Europe, despite ongoing disputes over tariffs, increased its imports of Chinese components, especially for electric vehicles and solar technology. At the same time, China's imports rose by 7.4%. Signaling stronger domestic consumption and a pivot toward regional trade patterns. Beijing is sourcing more raw materials from Brazil, Australia, and Indonesia, while building deeper manufacturing ties with India, Vietnam, and Malaysia. The picture is clear. China isn't just the world's production line anymore. It's becoming the logistical backbone connecting every end of the supply chain. Meanwhile, U.S. exporters are fading. Shipments to China have dropped to levels not seen since 2009. With soybean exports, once a signature symbol of American agriculture, now close to zero. The trade war that was supposed to box China in did the opposite. It pushed Beijing to diversify faster than ever. Washington built tariffs, China built friendships, and those friendships are now evolving into powerful trade alliances that reshape the world's economy. That growing influence is spreading beyond trade. More and more nations are conducting transactions directly in Chinese yuan instead of US dollars. Just 5 years ago, only about 15% of China's trade used its own currency. Now nearly 30% does. In cross-border investment and lending, the yuan already accounts for almost half. The shift is accelerating as nations seek safety from US sanctions and financial controls. Across Asia, Africa, and the wider global south, BRICS countries like Brazil, Russia, and India are deepening yuan-based trade systems. Over 130 nations have now joined Beijing's CIP's payment network, China's homegrown rival to SWIFT. Even European states are adjusting. France recently finalized its first major LNG deal with China, denominated entirely in yuan. Meanwhile, confidence in the US dollar continues to erode. The IMF reports that the dollar's share of global reserves has fallen from roughly 85% in the 1990s to under 59% today. Every new round of tariffs and sanctions from Washington drives more countries to seek independence, not out of politics, but self-preservation. What's unfolding is a quiet financial revolution. China no longer needs to win a trade war. It's building a parallel monetary network that operates outside Washington's reach. And as the yuan travels further through global trade routes, America is losing not just partners, but trust. The very foundation that once made the dollar unshakable. The world is dividing into two financial realities, and the line between them grows clearer each day. The United States is producing less, exporting less, and gradually surrendering ground in global commerce. Its share of world GDP has slipped from 33% at the turn of the century to around 26% now. China's, meanwhile, has climbed from a mere 3% to nearly 17%, and it's still rising. With that momentum, Beijing is constructing vast trade and payment systems spanning Asia, Africa, and Latin America, regions once dominated by US influence. ASEAN economies are now settling more of their trade in yuan, and the BRICS Plus group is developing clearing systems that bypass American banks entirely. This transformation wasn't built overnight. It's the product of decades. Ports, factories, and digital infrastructure woven together with one goal: to make global commerce revolve around China's orbit. Beijing's strategy is simple: no confrontation, just construction. Scott Bessent's attempt to contain China through press conferences and tariffs missed the bigger picture. He tried to challenge a global supply chain with slogans. Beijing, on the other hand, just kept building. One corridor, one deal, one payment route at a time. Washington can print dollars, but it can't print rare earths. The next great battle won't be about tariffs or markets. It'll be about money itself. Who controls it? And whose system the world trusts more? The dollar's future is no longer guaranteed. So, what do you think? Can America's currency hold its crown? Or has the tide already turned? Let me know your thoughts below. Don't forget to subscribe, and I'll see you in the next one. Page 4 of 4. Find in document.